In the winter of 1917, inside a marble banking building at 23 Wall Street, a ledger held a number no clerk wanted to say aloud. Over $2 billion in credits to Britain and France. On paper, America was neutral. In reality, its largest bank was already the purchasing agent for the British Empire. If the Allies lost, the loans defaulted and the losses would tear through American factories, farms, and savings. This is not the story of a telegram or a torpedo. It is the story of a country locked into a war before it ever voted on one. To understand how that lock was built, you have to go back to a document almost nobody remembers, written in the first weeks of the war. August 1914. The guns had just opened in Europe. President Woodrow Wilson had asked Americans to be neutral in thought as well as in action, and his Secretary of State, William Jennings Bryan, took him seriously. Bryan was the moralist in the cabinet, three-time presidential candidate, prairie orator, a man who had spent his political life warning that money and war were the same disease dressed in different clothes. He had made his name in 1896 with a speech about a cross of gold. 20 years later, he found himself sitting in the State Department, watching gold flow toward London, wondering how long the American conscience would hold. On August 15, 1914, he sent a letter to the House of Morgan. It said that loans by American bankers to any belligerent government were inconsistent with the true spirit of neutrality. The letter was short, the language was careful, but it drew a line that everyone on Wall Street understood. It was the closest thing the country had to a wall between Wall Street and the war. The wall lasted less than a year. The problem was the language. Bryan had forbidden loans. He had not forbidden credits. And to a bank, those are two different words for the same thing. When British buyers walked into American offices asking to purchase shells, rifles, horses, copper and wheat, they needed something to pay with. If they could not borrow, the orders stopped. And if the orders stopped, American exporters started firing workers. By the autumn of 1914, cancelled orders were piling up in the Midwest and along the East Coast. Steel mills were slowing down. Meat packers were losing contracts. Railroads that carried grain to eastern ports were watching cars sit idle in freight yards. Inside the State Department, a younger lawyer named Robert Lansing began to argue quietly that short-term commercial credits were not the same as loans. It was a distinction only a lawyer could love, but it was enough. In October of 1914, Lansing's argument became policy. The letter that had read like a wall was suddenly a curtain. Bankers pulled it aside and walked through. Bryan held on for another few months, but the ground was already gone under his feet. In June 1915, he resigned over Wilson's response to the sinking of the Lusitania. The moment he walked out of the cabinet, the last internal brake on Wall Street's war lending disappeared. Robert Lansing, the man who had helped rewrite the meaning of neutrality, replaced him at State. By the middle of 1915, American exports to the Allies had tripled. Exports to Germany and Austria-Hungary had collapsed to almost nothing. The Royal Navy blockade did part of the work. The credit asymmetry did the rest. Neutrality did not end when America went to war. It ended when a memo redefined a word. And once credits were legal, someone had to run them. That someone had an office at 23 Wall Street. The House of Morgan in January of 1915 was not just a bank. It was an institution that behaved like a government. Mahogany rooms, cables to London every hour, partners who took their meetings standing up because sitting down suggested the conversation was going to take too long. The old man, J.P. Morgan Sr., had died in 1913. His son, Jack Morgan, had inherited the chair and with it the family style. Quiet, formal, and absolutely certain of its own importance. Beside him stood Thomas Lamont and Henry Davison, the two partners who would do most of the actual work. On January 15, 1915, Morgan signed a document called the Commercial Agency Agreement. Under its terms, a single private American bank became the sole purchasing agent for the British government in the United States. A few months later, the same arrangement was extended to France. Read that sentence twice. A private American bank had just been appointed the official buyer for the largest empire on Earth, and the United States was still officially neutral. Over the next 2 years, Morgan would place orders in America worth more than $3 billion. Shells, rifles, horses, wheat, copper, steel, trucks, bandages, timber, boots, barbed wire, locomotive parts. Chemical dyes that had once come from German factories were now being manufactured at hurried scale in New Jersey. Entire American industries began to reorganize themselves around Allied specifications. Factories in Bridgeport, Pittsburgh, and Chicago were retooling for weapons that would be fired in Flanders and on the Somme. Farmers in Kansas planted for British bellies. Copper barons in Montana priced their metal against shell production in England. Ranchers in Texas raised horses for a cavalry that would be obsolete by the time the animals reached the front. The purchasing office Morgan set up occupied entire floors, rooms filled with clerks reviewing invoices from thousands of American suppliers, a special traffic department to coordinate railroad shipments to Atlantic ports, an inspection service to make sure the shells and rifles met specifications before they were loaded. It was, in every practical sense, a wartime ministry operating on American soil under a private name. The commission was small on paper, 1% on the first 50 million, sliding down after that. But the volume was enormous. By the end, Morgan had earned the largest procurement fee in American history without a single American soldier being sent to Europe. The strangest thing about the agency agreement is that it was not secret, it was published. It appeared in newspapers, congressmen could read it in their morning papers, and almost nobody in Washington asked the question that mattered most. What happens if the Allies lose? Because if they lost, the shells did not get paid for, the copper did not get paid for, the wheat did not get paid for, and the American economy would be holding an invoice with no signature at the bottom. America did not slide toward war. It was already inside the supply chain of one. But orders have to be paid for, and by the autumn of 1915, Britain was running out of dollars. The pound sterling was sliding on the New York exchanges. Bank of England gold was flowing across the Atlantic in unprecedented quantities, loaded onto steamers under armed guard, insured against submarines, and stacked in vaults in Lower Manhattan. Ministers in London realized that if the payments stopped, so did the guns. They needed to borrow in America from Americans in dollars and at a scale nobody had ever attempted before. A British delegation crossed the Atlantic in September 1915, led by Lord Reading, the Lord Chief Justice. They took rooms at the Biltmore. They met Morgan partners for hours at a time. They walked into meetings with the calm of men who had no other options. If the loan failed, the British war effort would stall by the end of the year. If it succeeded, an American precedent would be set that no one on either side of the ocean fully understood. The answer was the Anglo-French loan of October 1915, $500 million, the largest foreign loan in American history up to that point. A syndicate of 61 underwriters, led by Morgan, spread the paper across every major American brokerage. Full-page newspaper advertisements ran in every large city. The yield beat US government bonds, and the money went straight to London and Paris to keep the war moving. Now look closely at what was actually being sold. The loan was unsecured. There was no collateral. If Britain and France lost the war, the bondholders held nothing but paper, and the bondholders, in the end, were not just Wall Street firms. They were dentists in Cleveland, farmers in Iowa, widows in Boston, small businessmen in Philadelphia, ordinary Americans who had been told this was a good investment. They were not told they were buying a position on the war. The subscription pattern told a quiet political story. In the Northeast, the loan was oversubscribed within days. In the Midwest, it struggled. In the German-American belt around Milwaukee and Cincinnati, it barely moved. The country was already dividing along the lines that would shape the argument over intervention. And the map of who bought the bonds was the map of who wanted Britain to win. The loan was marketed as an investment. It was, in effect, an insurance policy. And 2 years later, Americans would be asked to redeem it with soldiers. Every household that bought a bond had, without knowing it, taken a position on the war. By the end of 1916, private American lending to the Allies had passed $2 billion. Some historians place the figure higher. Whichever number you trust, it was enough to make the outcome of the war a domestic financial event. But losing money is one thing. The next actor lost the illusion of neutrality without ever meaning to. While Morgan handled the buying and the borrowing, another bank was building the machinery underneath it. National City Bank at 55 Wall Street was run by a former financial journalist named Frank Vanderlip. He was not a Morgan. He had no aristocratic pedigree. He had climbed up through newspaper columns and Treasury back offices, and he had a very specific vision of what America was about to become. Vanderlip believed that London was finished as the world's financial capital and that New York would replace it. To make that happen, he needed American banks to do what British banks had always done: accept foreign trade bills, lend across borders, open branches in other people's countries. The Federal Reserve Act of 1913 had cracked the door open. Amendments in 1916 pushed it further. By 1917, National City had branches opening across Latin America and Europe. It was the first true American multinational bank. The old rule that American banks stayed at home was dead. Vanderlip's vision required a specific outcome. Britain had to win the war and be ruined enough afterward to need American capital to rebuild. The perfect scenario was a slow Allied victory. Anything else was a catastrophe. By 1916, National City was second only to Morgan in Allied credit exposure. It also held the largest foreign branch network of any American bank. Branches in Buenos Aires, Rio de Janeiro, Havana, Santo Domingo, Petrograd, Genoa, and eventually Shanghai. Every branch was a small physical marker of a shift that Washington had not yet named out loud. A private commercial bank had turned itself into a geopolitical actor, almost without anyone noticing. Here is the twist. Vanderlip himself opposed American entry into the war. He said so publicly. He wrote about it. He warned about the costs. And at the same time, his bank was making the entry economically necessary. He wanted the empire. He did not want to notice how it was being paid for. By the end of his career, Vanderlip would clash with Morgan interests, argue for a stronger Fed, and eventually be pushed out of his own bank. But the branch network he built survived. It became the physical scaffolding of American financial hegemony in the 20th century. Every plaque on every wall of what would later be called Citibank was, in some sense, a monument to a war he claimed he did not want. Two private banks, billions in exposure, and behind them a central bank that had barely learned to walk. The Federal Reserve was less than 3 years old when the war began. It had been created in 1913 to stabilize the American banking system, not to run a global credit machine. Its most important operational center was the New York branch, and the man who ran it was Benjamin Strong. Strong was tall, ill, and quietly ambitious. He had spent his career inside the Morgan orbit. He had helped organize the response to the panic of 1907 under the old J.P. Morgan. When the Federal Reserve System was designed, he became the first governor of the New York Fed, and from that chair he did something almost nobody expected. He turned a national institution into an international one. His main tool was gold. As the Allies paid for their American purchases, gold flowed across the Atlantic into the vaults of New York banks. By some estimates, roughly half of the world's monetary gold sat under Manhattan by the end of 1917. Guards on the streets outside the sub-treasury noticed the extra armored wagons. Newspapers ran occasional stories on the shipments, though the totals were rarely printed. Under Strong, the New York Fed managed those flows in ways that made it easier for American banks to keep lending. Discount rates were kept low. Acceptances of Allied trade paper were encouraged. The Fed's earliest institutional habits were shaped in real time by the needs of a war it had no legal role in. None of this was hidden. It was published in Federal Reserve bulletins. Congressional committees could have read the minutes, but the mechanics were technical enough that they moved beneath the level of public argument. Strong himself was pro-Allied by conviction. He believed British victory was in America's long-term interest. He also believed the Fed should not be openly political, so he built the machinery quietly. memo by memo, discount rate by discount rate, until the bank at the heart of the American monetary system had a settled institutional preference about which side of a European war should win. By the summer of 1916, that machinery had a problem. American banks were carrying enormous amounts of short-term Allied paper. If the war ended badly, those short-term notes would not be repaid, and the banking system would suffer a shock it had never been designed to absorb. Inside the Federal Reserve Board in Washington, a quieter faction began to worry, not about morality, about balance sheets. On November 28, 1916, the Federal Reserve Board did something almost unprecedented. It issued a public statement warning American banks against buying more short-term Allied Treasury bills. It was one paragraph long. It was written in careful, technical language, and it detonated across the Atlantic. London and Paris understood immediately what had happened. If the Fed pulled back the willingness of American banks to hold Allied paper, the entire financing mechanism could seize up within weeks. British bond prices dropped in New York. Sterling wobbled. Cables flew between the Bank of England, the British Treasury, and the Morgan partners. For a few days in December 1916, the entire war effort was closer to a funding crisis than anyone wanted to admit. Ministers in London held emergency meetings. American ambassadors were called in. Morgan partners worked to reassure investors. In Paris, French finance officials began drafting contingency papers for what a sudden American credit freeze would do to their army's supply lines. President Wilson, at that same moment, was trying his last serious diplomatic push for a negotiated peace. His famous request to the belligerents for a statement of war aims went out in December. In London, the timing looked suspicious. Some British officials genuinely wondered whether the American government was trying to use financial pressure to force Britain to the negotiating table. In the end, the Fed statement was walked back. Strong reassured Wall Street. Morgan reassured London. New credit arrangements were quietly extended. The panic passed, but it left a lesson that everyone involved would remember for the rest of their careers. Inside the Bank of England, the numbers coming out of that December were sobering. British reserves had dropped to a level where they could sustain unsecured American purchases for a matter of weeks, not months. In Whitehall, the Chancellor of the Exchequer, Reginald McKenna, wrote memos warning that Britain's ability to continue the war in dollars was now measured on a shorter clock than its ability to continue it in men. Those memos were not published, but they existed, and the men who wrote them understood exactly what an American central bank warning could do to a European war. The financial machinery that connected America to the Allied war effort was now so large that pulling on any one thread could bring the whole structure down, and the country that built the machinery had, in the process, made itself hostage to Allied victory. The warning had almost worked. It also proved beyond argument that the machine was real. If neutrality had ever been a wall, it was now a rope, and the rope was tied around a country that had never quite realized it was being pulled. But not every American banker wanted to pull, and that brings us to the strangest firm on Wall Street. Kuhn Loeb was not Morgan. It was smaller, older in its own way, and almost entirely German-Jewish in its founding partners. Its two most famous names were Jacob Schiff and Paul Warburg. Schiff was the elder. He had built Kuhn Loeb into one of the great American investment houses through railroad finance. He was philanthropist, community leader, and a man with one absolute political conviction. He would not lend money to the Russian Empire, not for railroads, not for war, not for anything. The reason was pogroms. Schiff had watched Russian anti-Jewish violence for decades, and he had made a personal decision, decades before the war, that his firm's capital would never fund the Tsar's government. That decision had a strange consequence in 1915 and 1916. When the Anglo-French loan syndicate was assembled, Kuhn Loeb refused to join because part of the money was going to Russia. It was a principled refusal, and it also cost the firm enormous fees. Paul Warburg, meanwhile, had a different problem. He was one of the architects of the Federal Reserve itself, sitting on the first Federal Reserve Board in Washington. He was German-born, and his brother Max Warburg, back in Hamburg, was one of the most important private advisors to the German government during the war. Paul had chosen neutrality personally. He had cut off correspondence with Max for the duration. He was, in his own view, an American public servant. But in wartime Washington, a German name and a brother in Berlin were not small things. Newspapers ran cartoons. Congressmen asked pointed questions in committee. His mail was quietly examined. When his term on the board came up in 1918, he did not seek reappointment. The pressure had done its work without a formal accusation ever being filed. He returned to New York with his reputation intact among bankers who knew him and permanently shadowed among Americans who only knew his name. Inside Kuhn Loeb, the war years were an internal fracture. Some partners wanted to join the Allied lending machine. Others followed Schiff's line on Russia. Others watched Paul Warburg's isolation in Washington with a quiet fear about what would happen to German Americans if the war continued much longer. The public did not see any of this. On the outside, Kuhn Loeb remained a great American firm. Inside, it was carrying the private tensions of a national moment that had no room for complicated loyalties. The firm's partners met in the same offices, walked the same corridors, signed the same letterhead, and underneath the letterhead, they disagreed about whether the country they had chosen was choosing them back. And then, in March 1917, the ground moved. In Petrograd, the Tsar fell. The February Revolution, March by the Western calendar, ended 3 centuries of Romanov rule. Nicholas II abdicated. A provisional government took power. Whatever else this meant historically, it had an immediate effect on American finance. The single largest moral obstacle to full Allied lending in the United States had just been removed. Jacob Schiff had opposed loans that funded the Tsar. The Tsar was gone. Within weeks, Kuhn Loeb was prepared to consider financing the new Russia. Wilson's own public reasoning about the war, which had always struggled with the awkward fact that America would be fighting on the same side as an autocratic empire, suddenly became cleaner. The old talking point that this was a war of democracies against autocracies could finally be said without a caveat. Some historians see this as decisive, others treat it as convenient timing. What is not disputed is the sequence. The Tsar fell in early March. On April 6, 1917, the United States declared war on Germany. Between those 2 dates, everything the previous 3 years had been building toward became government policy. Inside the Morgan offices, the mood shifted almost overnight. The private worry about Allied solvency, which had been a constant background pressure since 1915, suddenly had an ending in sight. If America entered the war, the federal government would eventually assume, in one form or another, the financial obligations of the Allies. The private paper on Morgan's balance sheet would be validated by the credit of the United States itself. Partners who had spent late nights doing arithmetic began to sleep again. The declaration itself was a political act. The financing of it was something else entirely. Within weeks of the declaration, Treasury Secretary William Gibbs McAdoo was drafting what became the first Liberty Loan Act, signed on April 24, 1917. $2 billion in government bonds sold directly to the American public. Look at that number, $2 billion. The same order of magnitude as the private Allied credits that had been extended by American banks over the previous 2.5 years. The mechanism was ingenious. The federal government borrowed from American savers. The federal government then used that money to lend to the Allies. The Allies used the loans to pay their debts to American banks and to keep buying American supplies. The private exposure that had accumulated on Wall Street since 1914 was, in effect, being refinanced onto the federal balance sheet. Private war debt became public national debt. Bankers who had spent 2 years worrying about what would happen if the Allies lost were suddenly holding paper backed by the United States Treasury. The Liberty Loan campaigns became a national spectacle unlike anything the country had ever done. Posters in every post office, movie stars on courthouse steps, Charlie Chaplin and Douglas Fairbanks addressing crowds in front of the sub-Treasury building on Wall Street. School children buying thrift stamps in classrooms across the country. farmers pledging harvests, Boy Scouts selling bonds door to door. Churches held pledge drives after Sunday services. Immigrants who had arrived at Ellis Island a decade earlier stood in line at neighborhood banks to prove their loyalty in dollars. The public was told in every possible way that they were financing freedom. That was true. It was also true that they were refinancing loans that had been made 2 years earlier by men most of them had never heard of, to keep an economic bet from going bad. Both things were true at the same time. By the end of the war, Americans had bought roughly $20 billion in Liberty bonds and Victory bonds. The federal debt had grown many times over. The old private lenders had been made whole. The banks had survived the war they had helped finance, and Wall Street had, in the process, become the center of global finance in a way it had never been before 1914. In 1934, a Senate committee led by Gerald Nye of North Dakota reopened these questions. The country was deep in the Depression. Isolationism was rising. A generation of Americans was looking back at the war and asking whether it had ever really been theirs to fight. The committee subpoenaed Morgan partners. It called Thomas Lamont, by then an elder statesman of Wall Street, to testify under oath. It read out numbers on the floor of the Senate. It produced the phrase "merchants of death" that shaped a generation of American isolationism and directly influenced the Neutrality Acts of the late 1930s that Roosevelt would spend years trying to work around. Later historians would push back. Niall Ferguson would argue the financial pressure has been overstated, that Britain could have found other ways to fund the war. Adam Tooze would insist it has been understated, that the American financial system had become the backbone of the Allied war economy long before Wilson signed the Declaration. Kathleen Burke, working through British archives, would document exactly how tightly Britain and Morgan had become entangled, and how alarmed Whitehall was when American credit trembled. The argument is not closed, and probably never will be, but the sequence remains what it is. A memo, a contract, a loan, a bank network, a central bank policy, a Fed warning, a family split, a revolution, a declaration, a national bond drive. Each one a step, none of them by itself a cause, together a structure. Wilson did not sell his decision. The Zimmerman telegram was real, the submarines were real, the moral case after the Tsar fell was real. Every reason he gave Congress on April 2, 1917 was, in his own mind, a true reason. What the financial history shows is not that the reasons were fake. It is that the room he had to say no had been narrowing quietly since August 1914. There is a final image that lives in the National Archives, 2 pieces of paper, a subscription certificate for the Anglo-French loan of October 1915, printed in green and gold, sold to an ordinary American investor, and a Liberty Bond certificate from 1917 or 1918, printed in the colors of the United States Treasury, sold to another ordinary American. Different names on the paper, different institutions behind them, different marketing campaigns, different newspaper advertisements, different sales pitches, but the money moved in the same direction, and the public one paid off the private one. The country that had believed itself neutral in 1914 had, by 1919, become the largest creditor nation on earth, and the ledger that made it so had been opened in the same marble building at 23 Wall Street where the story began. The war did not begin for America in April 1917. It began the day the memo replaced the letter. The full script is complete.